It's Friday, January 12th, 2024, episode 230. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, we welcome Mandy Xu, head of derivative market intelligence for the CBOE, to talk about all things volatility. We cover the persistent bid in the MOVE index, the incredible flipping of IWM skew, and why the volume in zero DTEs is not as worrisome as it might appear. Plus, I get to geek out and talk about the CBOE's newest dispersion index. Then it's time for Patrick's Talking Charts, where he tries to convince us that technical analysis is not just astrology for adults.
I swear, Kev, it is. Anyway, well, we end with the crayons with Kev and no stupid questions. And folks, we might even drink some beers along the way. So, Lena, hop on. What brew are we drinking this week?
Happy New Year, guys.
Happy New Year.
Today, the guys are drinking Sawdust City Brewing Company's 2-pad stack double IPA.
Kev? I spelled it all over my keyboard. I'm out of practice.
Oh, no.
Kev, it's 9%.
It's a strong one.
This is a strong one. This is for lightweights. This is a one and done beer. So I think by the time we get to the after hours, you're going to be slurring. I'm going to be
the first time.
Do you know what? For an IPA and for a big, like a 9.9, it's actually pretty good.
Yeah.
And it
tastes like a normal IPA. You can't tell it tastes the extra alcohol.
And it's got a great logo.
Yeah, of course.
Yeah.
It's pretty awesome.
All right, Patrick, before we do the side effects and the disclaimer, we got some special announcement. You got a gold webinar that is occurring this Monday. For those who want to hear all about what Patrick has got to say about this shiny little precious yellow fellow, you sign up on bigpicturetrading.com. And
we'll talk about it during Talking Charts there, Kev. But thanks for the plug.
Don't make it sound like it's me that's trying to plug this, buddy.
I appreciate the plug, buddy. Let's do the side effects.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. Side effects of too much huddle may include delta diarrhea, thirst trap theta, and premature accumulation.
You suffer from premature accumulation in so many times.
God. Take off, eh?
All right, let's get to the guest.
It's our great pleasure to welcome to the show Mandy Xu. She is the head of derivative market intelligence at CBOE. And Mandy, I've been looking forward to this for a long time. Thanks for coming on.
Thanks, Kevin. It's my pleasure to be here.
So we're going to talk about zero DTEs. We're going to talk about dispersion trades, VIX, and a whole bunch of great things like that. Before we do, let's get to know you a little bit before we do that. Although you're working in America now, you're actually not from America. I'd love to hear about where you're from and how you got to the CBOE.
Yeah, sure. It's so I would say despite my accent, I'm actually not American. I was born in China. I'm Chinese. I lived there for 8 years, and then my family actually moved to New Zealand. And we spent another 8 years there before moving to Toronto, Canada. And I didn't actually come to the States until college. So, since then, I've been here ever since.
So you moved from New Zealand to Toronto. We're from Toronto here. And I'm assuming that weather was a little bit of a shock.
It was more than a little bit of shock. So I described the weather where I grew up in New Zealand. So I lived in Auckland. I described the weather there as you can wear shorts in winter. And in fact, actually a lot of our school uniforms, it's shorts or like skirts for winter. So it does not get very cold. I don't think it's gotten below, 50 degrees consistently. So to go from that to Toronto was, quite the surprise.
So it's even warmer than Vancouver.
Yeah, exactly. It's very mild weather, like all year round. It doesn't get too hot in the summer and it's not too cold in the winter.
And meanwhile, when you came to Toronto, I heard that a lot of people thought you were from Australia. It's like we didn't know the difference between the two countries.
Yeah, it was funny. Like people be like, "Oh, where?" Because I had an accent at the time. They're like, "Where are you from? You sound so exotic." And I was like, "I'm from New Zealand." And some people say, "Oh, I'd always wanted to visit Australia," and I'd be like, "Actually, they're two different countries." Someone else told me, "Oh, is it in Europe?" And people were very confused to exactly where in the world it was.
As Canadians, you think we'd be a little more sensitive because I know that we hate being called Americans. So there you go. We think we be a little more aware of the New Zealanders don't like to be called Australians. Okay, so you're in Canada, you're in Toronto, and then you go off to America for school. Where do you go?
So I went to undergrad at Harvard, and I studied economics and government, which is just another word for political science.
And now, was that something you always wanted to do, or was this like, how did you stumble into that?
Yeah, sure. So when I first got to college, I think I was more thinking, something like studying like history or humanities. But I took an intro economics class, and I actually really loved it, particularly the macroeconomic component of it. And I really like kind of thinking big picture, and especially the intersection between economics and like public policy. So thinking about things like inflation, Fed policy, and unemployment, and how that has changed over the years, the different decades, different regimes. I loved like the big picture thinking involved in macroeconomics. Was not so interested in microeconomics in terms of, like looking at, supply demand charts and things like that. But the macro stuff I was fascinated by.
And at this time, was it like economic, what's the word? Like the economic metrics or whatever it is, like basically when there's a lot of stats going on, was it focused on that, or was it more like bigger picture theory?
So I have confessions. So I don't think I actually even went to my econometrics class in undergrad, because the professor, I mean, I'm sure he's a lovely guy, but he had the thickest accent and I could not understand him. So I think I skipped, I don't think I attended a single lecture that entire semester. But yes, there is a lot of statistics involved, but that was not a class that I particularly look fondly, back in.
That's funny. Okay, so you're from Harvard, you're at Harvard, you graduate. Where do you go from there?
Yeah, so my interest in finance, I would say, really started during one of my summer internships. So growing up, I didn't know anyone who worked in the industry, didn't really know anything about finance. But one of the things I did want to do was travel, right? I think particularly given my family background and, the fact that we moved around a lot, I really enjoyed, learning, meeting new people, learning new culture. So the summer after my sophomore year, I really wanted to travel to Europe and spend the summer there. But I had to find a way to kind of fund it, right? I didn't really have the money to just go to Europe for 3 months. So I started looking for summer internships there, particularly paid summer internships. And there weren't a ton out there. A lot of the ones, were unpaid internships. And one that was paid that I interviewed for and ultimately got was actually working for a macro hedge fund in London. And I distinctly remember the night before the interview, actually Googling, what is a hedge fund? Because I had no idea. But somehow I managed to get that internship. And I actually really loved it, kind of going back to my earlier point about thinking big picture. Yeah. I really enjoyed looking at macro trends. And I remember, someone they were just, sitting me down, explaining how in this particular case, the commodity price, I think this was an export of a Latin American country, how that had, impacted their currency, and that had an impact on inflation and monetary policy, and then the global ramifications of that. So, the big picture, again, seeing how interconnected different markets, different asset classes were, that was what really fascinated me. So after that experience, I ended up applying for a more traditional summer internship at a major sell-side bank. At the time, it was Credit Suisse. I got the internship, did the rotation, got a full-time offer to come back. And this particular offer was to come back to the equity derivatives desk at Credit Suisse, and that's what I did when I graduated college.
And what year was that been?
So very timely year of 2009.
Oh, okay. So you were in the midst of the crisis still.
Exactly.
Oh, wow. That must have been unbelievable.
Yeah, I would say it was probably the best time to start on a derivatives desk. Maybe actually no, the best time was probably 2007, right before the crisis.
Right.
But, 2009, 2010, we were still in the thick of it. I remember, a couple months into my job, we had the flash crash, and then we had the European sovereign debt crisis. There was one crisis after another for a number of years. And that was, that's exactly kind of what you want when you're on a derivatives desk, right, and really learning the trade.
So were you trading, sales, pricing? What was your role there?
Yeah, sure. So I've always been on the strategy team desk.
Okay.
So I started as a first year analyst. They had an opening on the strategy team. So basically what that team does is produce actionable insights and analysis and trade ideas for the bank's clients. So typically institutional clients like hedge funds, pensions, insurance companies, asset managers, etc. So I loved that role because it was to me, like a really good combination of using both quantitative skills, but also qualitative, right? So being a strategist, it's not just a matter of like being able to crunch the numbers and understanding complicated concepts, but also being able to explain them in a cogent way to other people to help others understand it. So the breaking down of something that is complex into something that is simple and able to, and communicating that effectively to others. That's actually what I really enjoyed about my job. So that's what I did, at Credit Suisse.
So now that must have been a lot different from your what you studied in university. And what was the learning curve like for you?
Oh, it's huge. But I think, for any, and I say this to all the interns, incoming interns and first year analysts, you'll learn everything you need to learn like on the job, right? Like I was actually probably the most useful class I took in undergrad was a intro computer programming class just to learn logics of, coding. Nothing like I really learned in economics or in my major was, it was very theoretical, right? And when you get to Wall Street, when you start your full-time job, you'll actually see, how markets move and how things actually trade and behave. And it's very different. So it's a very steep learning curve, I would say, for the first year or so. But, that's what actually, I really enjoyed was learning the practical aspect of it.
So now let's go through in terms of like how the market evolved during that point, because as you mentioned, you were at the tail end of the great financial crisis.
Yeah.
And then a lot of things were still happening. And if I'm not mistaken, I like equity vol stayed bid, right? And wasn't that the Buffett covering his S&P puts in 2010 or 2011? And I'd love to hear kind of some of your insights about those first few years and how volatility behaved and the different things that you saw.
Yeah, sure. I mean, I would say, again, we've definitely gone through, different cycles, different regimes. So coming straight out of, the financial crisis where, markets were down like 50+%, right? And in a short period of time, the focus, the first couple of years out of that crisis was all on hedging and tail risk hedging, kind of that. I just remember a lot of the conversations with clients was all like, what's the best hedge? How do I effectively manage my left tail risk?
Okay.
Right? So it was all about hedging. And I think that contributed to, one of the reasons why volatility was so big during that period. And then as you kind of move further away from the financial crisis, you can maybe argue it's complacency, recency bias, et cetera. But people started moving away from talking about hedging. And as markets, started going up, the view around, why hedge, right? It started kind of turning into like, well, you're just wasting money. You're like, spending premium, not really getting anything for it. And it's, causing underperformance and all sorts of things. So the conversation, I mean, that's definitely been a very pronounced shift is around, is around hedging, the necessity of hedging and why you should hedge. And then what risk are you looking at? The left side risk of market crashing down or the right tail risk of actually underperforming. So the upside, people nowadays look a lot more actually toward the upside risk, underperformance in an up market being a risk that they're particularly, sensitive to.
Like you probably didn't realize it at the time because you were just new on the desk, but that bid for the left tail was more persistent and took longer to get rid of than would have otherwise been the case, like let's just say in 2000 or even in 87.
Oh yeah, for sure. I think that was it wasn't just, vol and skew and these metrics that got very dislocated. I mean, if you think about, and I know we're going to talk about dispersion and correlation, but the correlation markets, I think it was in 2012, exploded, like, implied correlation went above 100, which, theoretically is not possible, right? And there were some big trades that blew up. And so, yeah, there were definitely many incidences of extreme spikes in all of these kind of risk metrics in the derivatives market in those years.
All right. And so you stayed at Credit Suisse until recently you've made the move to the CBOE.
Yeah.
What could you just tell us a little bit about your role there?
Sure. Yeah. So, I started thinking about like kind of next steps. I've been doing, derivative strategy for a while. By the end, I was running the group and it was great. Again, I enjoy the role immensely, but just thinking about like what next, what's the next step? So started talking to the people at CBOE and, the role that I eventually moved to at CBOE, the head of derivatives market intelligence. What I loved is that kind of draws upon my experience, as a strategist on the sell side. So part of my new role is still, providing that actionable insight and analysis onto the market and derivatives market in particular. But also there's a couple of new components to the new job, right? So part of it is actually helping with product innovation and bringing new products to market. And, again, we can talk about dispersion and other products, but we've come out with new tradable products, new indices. So helping with, education around that and helping clients understand the use cases of these new products. That's really interesting to me in this new role.
All right. So as you mentioned, we're going to talk about dispersion. And that's like when I first found you was actually because I got interested in this and I was like, I don't understand this as well as I thought I did. I'm going to go and I'm going to learn all about it. And I went and watched some of your seminars and learned all about it. And we're going to talk about that, but I know that we're going to lose some people when we talk about something really boring. So we're going to start with some fun, actionable things and talk about the market that we see right now. Let's just start with fixed income vol versus equity vol. Mm-hmm. And one of the big surprises has been that 2022 or 2023, actually, we saw a kind of instead of in the past where we saw equity vol leading any sorts of crisis, this time we saw fixed income vol lead the crisis. And not only that, we actually never had the spikes that many were expecting in equity vol. I would love to hear kind of how you think about that. And as we sit here right now, and the move is 106, but the VIX is 12. I was wondering if that's ever going to converge, and maybe what might cause it to converge.
That's a great question, and that's one that I've been asked by many, many different clients and over the past 2 years is what's been causing this divergence between rates vol and equity vol, and you alluded to it at the end, what's going to cause it to converge eventually, right? So to me, the divergence, a lot of people kind of frame it as a mispricing. Well, like one asset class has got to be right and the other has got to be wrong. And that's not how I think about it. I think about it's a mispricing only if both asset classes are reflecting the same risk, right? If they're reflecting the same risk, then clearly one is going to be right and the other is going to be wrong. But to me, what drives rates vol is really uncertainty around where the policy rate is going. And that's a function of the macroeconomic outlook. That's a function of inflation and Fed policy. And of course, over the past 2 years, we've had unprecedented volatility and uncertainty around those risks. So to me, the fact that rates vol is elevated is not surprising. Now, you get to equity vol. What drives equity vol, right? To me, equity vol really is driven by more recession risk rather than just general uncertainty around inflation. It's much more of a risk around economic growth and also leverage. So equity vol spikes tend to happen around forced deleveraging events. And I think that kind of gets to the heart of why we haven't seen a very meaningful spike in equity vol over the past 2 years, because you think about the sell-off that we had in 2022, it was obviously caused by, monetary tightening and high inflation, but those were very much anticipated risks, right? They were not kind of unexpected. Everyone was kind of, everyone in the beginning of 2022 was expecting, Fed to tighten, was expecting inflation to be high. And as a result, people started selling out of equities, started deleveraging. So it was 2022 sell-off was very much a story of deleveraging and moving to cash. And when you move to cash, right, you don't really need to spend money on options for protection, right? You don't need to buy puts. So there really wasn't that demand for volatility that we in 2022.
All right. So Mandy, in terms of the macro environment, you're saying that's what's driving the fact that the fixed income vol has risen, yet the equity vol hasn't risen. It's, in essence, although we've had increases in interest rates, we haven't really had any sorts of economic stress yet. Is that correct?
Exactly. So I think, and that's why actually, if you look across other asset classes, it's not just equity vol where volatility is trading, very low or significantly below average. If you look at the credit markets, credit spreads being very tight and credit volatility also being very low. Similarly, in the FX market and the commodity market, I think all of these asset classes are really reflecting the soft landing, consensus narrative that we're in right now, whereas the interest rate market is much more sensitive to the overall like inflation versus growth kind of picture. But the other asset classes like equities is very much just narrowed in on the economic growth risk, and the fact that 2023 versus 2022 we saw a huge increase in the probability of soft landing, which is much more positive for risk assets.
Right. And one of the things, though, I'm just kind of thinking this through in my head, the fact that the market was expecting equity vol to go up, yet we haven't seen that. And it's almost like they've now accepted that the economy is not as sensitive to interest rates as we thought. And one of the kind of, I guess, watershed moments of this move might be a function of the fact that in the past, interest rate rises actually did crush the economy. And then we did have problems with delevering whenever we rose rates. And I distinctly remember, when we hit 200 basis points, which was the previous high when the Fed had risen to the previous high of the last cycle, and everyone said there's no way we're going to get past 200 basis points. And yet here we are at 500 and the economy is still going. To me, it shows how this cycle is different. I would just love to know, do you agree that this cycle is a lot different than previous cycles?
Definitely it has been very, very different. And I say, one of the big differences to me is on the fiscal side, actually. So the fact that, at the same time we had unprecedented monetary tightening, we've also had a huge unprecedented amount of fiscal stimulus, right, that we saw coming out of COVID that took time for really consumers to spend down all of their pandemic savings. I think that was the buffer that really kind of held the economy together as the Fed, went about raising rates.
So does that mean, going back to the final part of my last question, where it's what was going to cause the move and the VIX to converge, could be maybe the new normal? Like maybe they're not as mispriced as we think.
Yeah. So I would agree. I think it's not as mispriced as we think. And to me, really, what is going to cause rates volatility to come down is really an ultimate, just more clarity around exactly where we're going to land in this whole soft landing versus hard landing debate, right? Because right now, the consensus appears to be soft landing, but we still don't know. And the reason we don't know is that, inflation is coming in and growth is decelerating, but we don't know whether it's decelerating for the right reasons of soft landing or actually the wrong reason of actually we're going into a recession. So in both cases, the trend right now is still going to be the same as both inflation and growth falling. Just how much is going to fall and how hard it's going to fall, that's still yet to be determined. Personal views, I think we're headed for a soft landing, but certainly you cannot at this point rule out a recession or hard landing. I think until that gets ruled out, I do believe that rates volatility will remain actually relatively elevated in this backdrop.
Now, one of the things that you've been writing about recently is the fact that we had this fourth quarter chase in the options market and the equity market. And you mentioned particularly small caps. I'd love to hear your thoughts about that.
Yeah, sure. Maybe just tie it into the previous point I make about, like hedging of left tail versus right tail risk, and how coming out of the financial crisis, it was all about left tail risk. But in recent years, it's been definitely more and more focused on the right tail risk. We definitely saw that in Q4 of last year. And it was not just within small caps, but, particularly pronounced for small cap equities. We saw it in S&P, in NASDAQ, and all of the major indices. There was a huge bid for upside calls because most investors, again, coming into 2023, we were pretty bearish. People were under positioned, not prepared for the rally that we ended up getting. And then in November, December, as we got, the Fed pivot, as we got the better than expected CPI data, there was a huge chase into year end. People were chasing performance and buying upside calls to really kind of to do that. And to give you a sense of how dislocated everything got in the derivatives market, particularly if you look at the Russell, and again, that's what people gravitated toward for the catch-up trade, because Russell had been lagging the S&P for much of the last 2 years, and it's very sensitive to cyclical growth. So if you're expecting cyclical growth to get better on the back of Fed pivot, Russell obviously in this case will likely outperform. We saw such a demand for upside calls in the Russell that skew actually inverted. So
okay, let's just take a moment here for those who don't know skew. Exactly. Explain what it is and why that's so significant.
Sure. So skew essentially in the options market, skew measures the demand for puts versus calls. So when skew is high or steep, as we call it, it means there's actually a lot of demand for that downside protection. People are fearful. They're buying hedging. They're buying hedges. When skew is low, it means the opposite, right? There's a lot more demand for the upside call. And when skew is inverted, it means actually calls are trading at a premium relative to puts, which at the index level is almost unheard of. Generally,
Right.
people buy index options for hedging purposes. So puts always tend to be more expensive than calls. But we actually had the opposite happen in Q4 of last year in the Russell, where the upside call actually got more expensive than the downside put. The last time it happened in Russell was in 2005. So we're talking about, almost like a 20-year, once in a 20-year type of phenomenon that happened in December of last year.
And that's fascinating. And actually, for those who are interested, generally the skew is to the downside, because we all know that line that the stocks take the elevator down and the escalator up. And usually on the upside, it's a little more subdued affair, and it's just kind of grinding higher. But yet this time in the S&P, the small cap and the IWMs, it just exploded to the upside. Do you think that options are affecting the speed upon which those things get repriced?
I don't think it's. I don't know if you're maybe meant like, is it exacerbating the way that
I guess so. Like, is it the use of these products? Is it like the fact that hedge funds come in, they grab these options, they get the dealer short gamma, and then all of a sudden there's a little bit of a feedback mechanism?
Yeah, so I think what you describe certainly could be a factor and was a factor, at the single stock level in recent years. And I think that's because the overall liquidity in the underlying the single stock level is not that great, such that if you had, outsized option activity, then the associated hedging with that, could be a disproportionate kind of percent or amount relative to the underlying, that it could drive the underlying, right? Like we all saw that in 2021, with GameStop and a lot of the meme stocks, where people were buying those upside calls and dealers were getting squeezed, short gamma, and hedging of that short gamma position really kind of took the stocks explosively higher.
Right.
So yes, I would say absolutely at the single stock level, it can have an effect. And, in 2021, we definitely did see that have an effect. But at the index level, particularly when you're talking about like the S&P or the Russell, which is, very, very liquid, I'm a little bit more skeptical about, the impact of option hedging on the actual underlying index and where it can go.
So one of the things that has been your big success story at the CBOE is the zero DTEs. Why don't you explain to people what they are? And also you have a new one that is that you're launching recently, or you have launched, and it's kind of exceptionally apropos given what we just talked about with the small caps.
So zero DTE essentially refers to trading of options that expire that same day, right? So, it's existed for a very long time in the sense that, any option at some point is going to expire. So any trading activity that happens on the day of expiry, that counts as zero DTE trading activity. What really refers to is the fact that in April Q2 of 2022, we added Tuesday, Thursday expiries to the weekly options to complement our existing Monday, Wednesday, Friday expiry, such that there's now an option expiry for every day of the week. So that really really jump started a lot of the zero DTE trading, because now there is an expiry for every day of the week. So for anyone who's running systematic strategies, you can obviously replicate it daily. And that has really taken off to the point that for last year, about 47% of all option trading activity in the S&P happened in zero-day options. So it's grown to be a huge percent of the overall volume. And along with that, explosive growth in terms of volume and activity has come a lot of, attention and speculation, and people, wondering like what's driving it. So maybe I'll just spend, a couple minutes kind of breaking down and really hoping to clear up some of the most common misunderstandings around zero DTE option activity. So the number one question I would say by far that we get is kind of who's trading that, right? Is it retail? Is it institutional? And this actually is, I would say, the hardest question to answer, measure because we don't really see who the end customer is who's trading these options. We can see, where it originates from, whether it's a retail brokerage firm or not. But even in that case, it gets a little bit dicey because a lot of retail brokerage firms also service institutional clients, right? So we know a lot of hedge funds, for example, and other institutional investors trade through Interactive Brokers, which we count as a retail brokerage platform. So we've done, several layers of analysis looking at not just where it originates from, but the size of trading, frequency of trading, et cetera. And our best estimate in terms of who the ultimate end customer is, we think about 40% of the trading in 0DTE come from retail clients, and the 60% come from institutional clients.
Okay.
I would say it's actually a pretty balanced mix. It's not quite 50-50, but 40-60. I think it's still pretty balanced.
Right. And
then the other thing to really emphasize is that there's diversity of use cases with 0DTE. So I think people, when they think about, retail trading 0DTE, they think immediately to the meme stock era where everyone was buying options, buying call options, as we talked about, right? So they think, well, if everyone's buying, these 0DTE options, the market makers must be short on the other side, and they have to hedge. And if it's 47% of all SPX option volume, we're talking massive risk that needs to be hedged. But what we actually find is that the trading in 0DTE is extremely balanced between puts versus calls, and is extremely balanced between buys versus sells, such that the net imbalance at any given time, we're talking, like 1% of overall volume.
Oh, okay.
Yeah, and that's actually what matters. So I think this is the biggest misunderstandings. People look at the notional volume that is being traded in zero-day options, which admittedly is huge, right? Hundreds of billions, if not even approaching $1 trillion. And they think if it's all one-way risk, that is a lot of risk for market makers to hedge. But if it's evenly balanced, then net, you actually had very little risk to hedge. I think, our analysis showed on average, we're talking a couple $100 million, for market makers to hedge, which, in the context, again, of the S&P, which trades, 400, 500 billion a day, that's nothing. So I think that's, what I'd like to emphasize is risk is not the same thing as notional volume. And to really get a sense of the risk of the product, you have to look at the net flows, right? The net buys versus sells. And what we observe in 0DTE options is that, there are people who are buying these options for directional views, to hedge, but there are also a lot of people who are selling these options for income. So, because of that, you get a very good balance.
Got it. And so you have the SPX, the NDX, and now recently you've added the RTY.
Yeah, so SPX is our product. NDX, NASDAQ is their product. But
sorry. I'm sorry. I didn't mean to mention that.
I think it's important to kind of let people know, what's the universe right now of 0DT options, right?
Yep.
So right now you can trade 0DT options in the S&P family, SPX, SPY, the ETF, XSP, which is the mini S&P index. You can trade it on the NDX family, NASDAQ family. And then more recently, we actually added onto the Russell. So Russell, the 2000 index and the mini Russell index, you now also have daily expirations, so 0DTE options.
Okay. So now we're going to get to the part that I wanted to discuss. We're going to talk about dispersion. But before we do that, I think it'd be kind of helpful if we kind of went through VIX, what it is, how it works, because it's integral to understanding dispersion that we need to understand VIX. Yeah. So first of all, a lot of people think it's just the implied volatility of the at-the-money option of the 30-day SPX. So why don't you just take a moment to go through and really give us your version of kind of your best attempts at explaining it for someone who wouldn't know the product?
Sure. I mean, you're not all that wrong in the sense that it is kind of the benchmark measure for implied volatility of the S&P. I think where, the technical, like the difference is that it's not the implied volatility of the at the money strike, right? It actually, the calculation of the VIX incorporates a range of strikes in the S&P. It's, most similar to those who are familiar with, variance swap. It's almost like a variance swap on the S&P. But basically what it means is that the VIX is a measure of incorporating not just the at the money volatility, but also skew, right? What I mentioned before, the put versus call, because it incorporates, options of a variety of strikes, you do get that skew dynamic in the VIX as well. But I would say simplistically, for someone who just, wants to know what is the VIX, the VIX measures how much the S&P is expected to move in the next 30 days. That's all it is. And I think what people, maybe the misunderstanding happens is that they think the VIX is somehow a fear gauge. And I would push back on that because just because, the VIX is expected to move a lot, just because, a high VIX signals that the S&P is expected to move a lot, it doesn't actually directionally tell you whether people are bearish or bullish, right? As we saw in Q4 last year, it was very much the bullish sentiment that was driving, the demand for options.
Right. I always highlight the late 1999 period when actually volatility rose in a market that was also rising.
Exactly. Yeah.
And I think people miss that.
Yeah.
All right.
All things equal, right? With the VIX, the way that it's currently constructed, all things equal, if someone came in and bought a lot of calls on the upside calls on the S&P, all things equal, VIX would go up. Right. Well, that's why it's not quite a fear gauge because it could be driven by that bullish activity.
Now, the thing we have to understand about the VIX as well is the VIX is the market implied volatility of 30-day options, kind of the range of 30-day options. And so could you explain to people what volatility risk premium is and how that works?
Yeah, sure. So volatility risk premium essentially refers to the difference between implied volatility and realized volatility, right? So what is how much the market is, if we talk about the S&P, right? How much the S&P is expected to move and how much it actually moves. So realized volatility is a statistical measure. You just look at the daily returns of the S&P, you can calculate it. It's always a backwards looking measure. Implied volatility is always a forward looking measure, how much, it's expected to move. And what it essentially refers to is that the market always tend to on average overestimate, the subsequent realized volatility. So that gap between implied to realized typically tends to be positive, meaning that option buyers are typically overpaying, if you will, and option sellers are, monetizing that positive premium between implied versus realized.
Right. So we could have a situation right now where the VIX is implying 12%. Or let's not even talk about the VIX. Let's just say at the money, S&P straddle is at 12%. And in the ensuing next 30 days, it actually realizes 5%. Yeah. And the option seller, if they delta hedge throughout that period, would make money.
Exactly.
Right.
So the distinction that I like to make is that, volatility can be low, but it doesn't mean that it's cheap.
That's right.
And that actually, if we go back to 2017, which is, notorious now for being a very low, it's a record low volatility year in the equity market, right? VIX, I think that year, I want to say averaged 11 or maybe averaged 9. It was extremely low. But if you looked at the realized volatility in the market, it was actually even lower. And the implied to realized spread that year was firmly positive, right? It was actually, above average in terms of how much was being priced in the implied volatility market. So I think that's just another way of saying, like, just because it's low, it doesn't mean it's cheap. Like if you were carrying a long volatility position in 2017, it would actually have been very, very expensive despite the low absolute level in the VIX.
Right. So now when someone trades VIX, they need to remember that they aren't trading what the market is actually going to realize in terms of volatility. Yes. But what the market will be pricing in as the expected volatility for the next 30 days in the future.
Right. So I think you're talking about VIX futures, right? Yeah, exactly. Yes. When you're trading VIX futures, you're making a bet on future levels of the VIX, right? So you're making a bet on where implied volatility will be in the future. So it's an implied to implied trade. So, you're buying futures and then you're trading on where the implied level of the VIX is going to be in the future. Very different, from the delta hedged straddle that you talked about, or from buying variance swaps on the S&P where you're playing that implied to realized spread, that volatility risk premium. That is not what you're capturing when you're trading VIX futures.
Right. Like we could have a situation where, let's just say that there's no volatility for the next month, but then there's some sort of election or some event that makes it so implied volatility goes up a month from now. And you could actually have a situation where buying the VIX works, but buying realized volatility doesn't work at all.
Exactly. So there could be differences in how implied volatility trade due to pricing of upcoming events. Exactly to your point, like if we're going to an election, like we saw, for example, in 2020, the VIX futures curve and then the VIX started really pricing in that election risk prior to the event. So you could definitely get a rise in the VIX going ahead of the event, but actually nothing happening in terms of the realized volatility in the market because the event hasn't happened yet.
Right. Okay. So now let's talk about dispersion. Okay. And first of all, let's just say you have a new index. Could you tell us the symbol and whose brainchild it was and why you guys have made this.
Yeah, sure. So the new dispersion index that we launched, the ticker is DSPX index. So it's the CBOE S&P 500 dispersion index. And maybe before I go into the details of the dispersion index, just briefly for those who don't know, like what exactly is dispersion, right? And why do we care? So just, like we talked about the VIX, right? So the VIX measures the volatility of the S&P index itself. Dispersion measures how the stocks within the S&P move relative to each other. So that's what the DSPX is designed to measure. And again, like the VIX being the implied volatility measure for the S&P, how much the S&P is expected to move in the next 30 days, DSPX measures how much the stocks within the S&P itself is expected to move relative to each other for the next 30 days. So it's an implied dispersion measure, just like the VIX is the implied volatility measure.
Okay,
you can almost think of like DSPX is like the VIX for dispersion.
Right. So let's go back though, and let's try to explain kind of realized dispersion so that people can really grasp that and really understand what it means. Okay. Yeah. So yes, the dispersion index is like the VIX. It's an implied rate, and we'll get to that level. But first, let's just kind of talk about realized dispersion and what it looks like and how it varies.
Yeah, I mean, the best way maybe to kind of think about dispersion or illustrate dispersion is with a chart, which unfortunately I can't show you guys, but maybe we simplify it when you think about like, an index of two stocks, right? And one stock goes up 50%, the other stock goes down 50%, right? When you average it out, like an equal weighted index, the index actually didn't move, right? So, they think about like, if there was a VIX for that index, it would be zero.
Yeah.
For that day, right?
Yeah.
But you had incredible volatility underneath the index surface. So that is dispersion, right? On a day like that, where one stock goes up 50%, another goes down 50%, that's high dispersion. On the other hand, you could have another day where both stocks really didn't move. So that would be low dispersion. So the dispersion measures the volatility of the stock returns relative to each other.
I think that's fascinating. And I'm just going to take a quote from one of your presentations you guys did. And it says, dispersion is like volatility in that it is a measure of risk. There is more of a chance of losing money in a higher dispersion environment, but there's also more of a chance of making money. So it's the value to be had by making a good selection versus bad.
Yes. Actually, I love that. So it really, so you think about like dispersion in a high dispersion environment, it's really when it pays to be an active investor, right? An active stock picker. Because that is when, picking the right stocks, and, go back to the simplistic case of, one stock up 50 and down 50. If you correctly called, beforehand which stock was going to go up and down, you made 100%, right? In that trade, right? In a high dispersion environment, there's more P&L to be made by being a stock picker, or more potential P&L to be made by being an active stock picker. Whereas in a low dispersion environment where every stock is kind of like, moving along like the index, then actually it pays more to be a passive index investor in that sense, just getting average returns, because there's not much differentiation between the stocks. So you can also think of dispersion as a measure of kind of potential stock picking alpha, or how much the opportunity set for being an active investor.
So one of the things that you've been talking about in terms of the different environments is obviously 2021. And why do you just kind of highlight how the dispersion during that period was so high versus another period, like even just recently?
Yeah, actually, so one of the remarkable, I think, features of the past, say 18 month, 24 month has just been how elevated dispersion has been, even as the VIX has declined, right?
Okay.
From the highs. So basically what it tells you is that, again, you think about dispersion, what drives dispersion, it's really fundamental equity risk. It's stock earnings, it's, direction of rates, it's fiscal policy, things like that really drives, which sector is going to outperform relative to the other. And I think it really speaks to the market environment that we've been in recently, where investors have been playing direction of rates and all these macro trends through sector rotation, right? And through factor rotation, is it growth to value? Is it cyclical versus defensive sectors? Is it, the large cap tech names versus the old economy stocks, right? Those have been kind of the trades that have really worked or not worked. You think about tech being, down 40% in 2022 and up, 40% last year, right? despite overall muted levels of index volatility, we've seen very high levels of volatility at the stock level and also at the sector level. And that's why dispersion has been elevated, even as overall levels of the VIX have been, relatively muted.
Just as a little of a side, I've noticed this myself when I watch the QQQs versus the IWM, which is the small cap. They almost seem like they're inversely correlated.
Mm-hmm.
And it's been just shocking to me. And part of the reason that I've kind of went down this dispersion kind of rabbit hole is I'm almost wondering if the fact that all these dealers have this trade on, it's a self-fulfilling prophecy where they're almost creating the kind of that negative correlation between those two sectors or stocks.
Yeah, I mean, I would say it's not even just these two sectors or these two underlying things. You can see it at the sector level, like with a lot of the sectors, right? The rotation that we've seen over the past 2 years has been really unprecedented or, extremely elevated by historical standards. And that's something that, I tell investors to really keep an eye on, because you think about like, how could this current market cycle end? And we think about, this whole hard landing versus soft landing debate. Well, in a hard landing, historically, correlation always picks up if we're going to recession, right? Everything sells off together. And right now, if you're looking in the options market, implied correlations at or near historic lows across a variety of tenors. So at least in the options market right now, there's pricing of there's almost zero pricing of that downside recession risk. You can look at whether you can look at the skew. We talked about that earlier. You can look at the correlation. It's very much a consistent picture of investors looking kind of still at this environment of, high dispersion, high stock, sector rotation, but not really that macro driven correlated sell-off on the downside. There's still very little risk being priced for that scenario.
Okay, so let's talk a little bit about how this index is created and what it's really saying when you kind of get a number from it. First of all, I guess I'll let you do it. How would you explain to somebody what that number means if they see the DSPX at like 50?
Yeah, sure. So a DSPX value, so I think it only hit 50 once. Okay. So that's like a pretty rare value. I think right now it's around in the 20s. But essentially it's the one standard deviation cross-sectional return of the stocks within the S&P, which again sounds very technical, but think about like the VIX being like the one standard deviation of a potential move in the S&P. This is the one standard deviation move of the underlying stocks in the S&P itself. And if you look at it if you look at the history of the index, the typical range for dispersion is between 20 to 26. So that's kind of, I would say what's typical range. It's hit extremes on either end. So once in February of 2018, it actually hit zero. So when you pull up the dispersion DSPX chart, that's not a misprint. It actually did go to zero. And for anyone who's around at that time, you can recall that was 𝙂𝙂, where again, that was a sell-off that was very much technical driven liquidity event at the index level, had nothing to do with stock fundamentals, which is why dispersion went to zero. It was a bid for index vol, not for single stock volatility. And then on the other end, it went to an all-time high, I think around 50 or almost 60 in March of 2020, when there was incredible amounts of uncertainty in terms of macro fundamentals due to the pandemic.
Okay, so dispersion, again, we're talking about when we do the DSPX, it's an implied dispersion. So this is what the market is expecting for the dispersion within the index. And in times of high correlation, it goes up. So as it goes down, it means that they're expecting that dispersion to continue to be, like, for the stocks to be moving more uncorrelated. Is that correct?
Yeah, so I think there's a lot of people think like correlation dispersion have to be inversely correlated. And I think that's one of the more surprising things that people have starting to I think realize and discuss, once we publish the DSPX index, is there can be times when they are inversely correlated, but there are also times when they are correlated. So for example, March of 2020, you had extreme high correlation, but also extreme high dispersion. And the way, think about it is both measures are measures of risk, right? And so, during periods such as March of 2020, any measure of risk in the market should be going up. So really was telling you was, and in March of 2020, there was incredible increase, both in terms of the outlook at the stock level, in terms of earnings outlook, but also a huge increase in terms of market-wide risk, right? Because of the pandemic and the shutdown. So there was it was a macro event that also created a lot of uncertainty at the single stock level. So you had increase in dispersion and increase in correlation at the same time.
Okay, now let's talk about the fact that it went to zero in the Volmageddon, because I think that if you explain that, people might be able to understand a little better what it's really signifying.
Yeah, sure. So if you look at DSPX and dispersion, in general, in the formula, right, it's really looking at the difference in single stock volatility relative to the index, right? So when you think about fundamentally, high dispersion, lots of volatility at the single stock level, right? So high single stock vol relative to index vol. Well, what happened in Feb of 2018 was the opposite, right? There was a huge liquidity event at the VIX, in the VIX product space with the VIX ETNs, a huge spike in the VIX, but it wasn't really anything to do with fundamentals. It wasn't that people were pricing in more earnings risk. It wasn't because, the Fed changed the outlook for rates. It had nothing to do with fundamentals of the market. It was really a liquidity event centered around the VIX ETN, the inverse ETN space. So because of that, what we saw on that day was single stock volatility really didn't move all that much, right? Because again, it was not a fundamentally driven shock. It was really a index vol, technical move. So that difference between stock vol and index vol actually collapsed and went to zero. So that's why the index went to zero.
So just to explain that a little further, if you could have transacted, you could have sold the index vol, meaning sell the VIX or sell all like a straddle or some sort of product that sells the index vol. And then if you could have bought all the individual stock vols that made up the kind of the S&P 500, it would be a riskless trade.
Well, I don't think necessarily.
Well, when it trades negative, would it not be riskless at that point?
I guess if we had DSPX futures at the time, that would have been one way. But, if you were trading, first of all, keep in mind that the liquidity in the market on that day was particularly, I would say, poor.
Yeah.
And, a lot of this happened kind of into the close. So, your ability.
Fair enough. I'm just saying, like at the closing prices, when that DSPX ticked at zero, like it went to zero, it was basically saying that the index vol relative to these individual stock vols was much too high.
Correct. Yeah. And actually, technically, if you want to kind of dig into the technicals, it actually went, because the DSPX formula, it's a square root. So actually the spread went negative, but obviously because you can't take the square root of a negative number, we kind of capped it, we floored it at a zero.
Right.
But on that day, the index vol was bid, so high relative to single stock vol, the weighted single stock vol, that spread actually went negative.
Right. And so to some extent, this product of the dispersion, and you guys hope to have a future and to have options on it, is the ability to switch between a bunch of options that represent the single stock kind of expectation versus the index vol. Am I correct?
Yeah. And also, I think, having DSPX, if DSPX was, was live at that point, it would have been very easy for people to understand that the move in the VIX at the time was very much a technical move, right? It was not anything to do with the fundamental. So having DSPX at the time, not if you were able to trade it, obviously you can take advantage of the move, but also just having the index itself, I think would have helped people to understand what was driving the VIX. And that's kind of part of why, the reasons why I decided to create the index is it's a complement to the VIX, because it can tell you when something is a fundamental driven move in the market versus a technical move.
Right. So now I went and spoke to some, I guess they're called correlation desks. And I'm not really sure, but on the sell side, and my understanding is that in general, and obviously you're on the CBOE side, you're not going to know exactly, but if we could just talk maybe in generalities, the desks are usually short correlation, meaning that they're long the individual stock volatilities and they're short index vol against it.
Yeah.
Is that correct?
Um, so yes, so basically you think about like the typical customer trade,
Yep.
right? So at the single stock level, you typically get a lot of overwriters and underwriters. That's kind of been the predominant flow in single stock options, particularly the past couple of years. So the sell side trading desks tend to get long a lot of single stock volatility.
Right.
And then, at the index level, again, typically what you do is you see people who at the index level typically buying hedges, right? So the desk itself is short. Correct.
Right. So the past couple of years have been terrific because they've been long all these single stock options, and we've had basically tons of variance in terms of all the different stocks moving different ways and things like that. And then meanwhile, the thing is the individual stocks the index has been muted. Back to your example about, like, obviously it's not this good, but to your equally weighted index that one goes up 50% and one goes down 50%. If you're short the index vol, the index doesn't move at all. And then meanwhile, you're long volatility on the individual, you win on both sides.
Yeah.
And so now the problem is, my understanding is that this has gotten to be a crowded trade, and eventually, I guess one of the worries is that that there's the ability to transfer this risk is difficult. And is that what you guys are seeing when you're thinking about making a future and index product on this? They make it so these dealers have the ability to offset it to pension funds and other people of that nature that can take this risk a little better?
Certainly, I would say that is that's one use case, for the futures, right? On DSPX is for people to hedge existing dispersion positions. But I would say the use case really is meant to be broader. It's meant to be broader than that. So a couple of things I would probably highlight on the futures. Again, we haven't launched the product, so I don't want to go into too much.
No. And just to be clear, we're 6 months, a year away from this product being going.
Exactly. So to temper expectations, but also to kind of explain, the why we're doing this and why we're excited about this upcoming launch of this product. So a couple things. So for the people who are actively currently trading dispersion, I think, the feedback we've gotten from that community is that it's complementary to what they're currently doing, right? Whether that's complementary to hedging existing positions or, it's not replacing their existing trades in the sense that most, of dispersion trades out there, it's capturing that implied to realized spread, whereas DSPX futures would be, an implied to implied trade. So it's a different risk premium for you to capture. So it's complementary. It's not meant to replace any existing dispersion trading. But the second thing that, the second use case, if you will, for DSPX futures is currently dispersion is a very esoteric risk premium and a very difficult one for most investors to access or trade, right? So typical dispersion trades, whether you trade at OTC through variance swaps, which include managing a basket of single stock variance versus index variance, or if you trade in the listed space, we're talking, hundreds, if not thousands of listed options that you have to manage in order to get that exposure. It's operationally difficult and it's capital intensive, right? With the DSPX futures, it's one contract, it's listed, it's centrally cleared. It makes it easier, significantly easier to trade. And as a result, hopefully more accessible to a wider audience of investors.
That sounds awesome. All right. Now, before I let you go, we're going to do a few more things, but I want to talk about one more of your products that you guys have recently launched that I think is just one of the greatest products out there, but nobody else seems to agree with me. It's the iBox futures. Why don't you tell people what they are and why I think they're so nifty?
Yeah, sure. So we launched the futures actually, I think right before the pandemic, which probably explains why the uptick maybe hasn't been as great or as fast as we had hoped. And then last year we launched the options on the futures themselves. So the two kind of futures contract are based on the iBox investment grade index. So there's the investment grade contract, and there is a high yield contract. And by construction, the underlying index is about 99% correlated to the ETF product that I think everyone's familiar with, HYG and LQD. And it's, 99% correlated by construction because the index actually looks at the holdings of the ETF on a monthly basis to make sure it actually tracks the ETF. And the reason we did that is we wanted to kind of tap into that underlying pool of liquidity, right, in the ETF. So Now the question is, okay, so then why trade the futures instead of the ETF, right? Like, well, what's the incentive or what's the use case? So a couple of use cases. I would say for investors who are typically going long, right? So if you're buying HYG or LQD, being able to do so with futures means that you're putting less in terms of initial margin, 5% margining on the futures versus 50% for the ETF. I would say, compared to, I think another alternative that people look for on the long side is trading total return swaps. And compared to those, the futures, they're a listed centrally clear product. And right now there's a lot of regulatory changes that makes, trading total return swaps and uncleared, swaps actually much more punitive from a capital perspective. The second use case is if you're someone who wants to hedge your corporate bond portfolio, you're typically shorting, HYG or LQD. Well, I think a lot of people are aware, there's usually typically a high cost to borrow and sometimes can be very difficult to locate the shares to be able to be borrowed. So I think for example, HYG in 2021, the borrow cost went to as high as 8%. And as you know, with futures, it's much easier to short with futures compared to the ETF. So I think that's kind of, the why we're starting to see a lot of traction and interest in these products. And then maybe the one thing I would add on top of that is the options on the futures and the difference between ETF options versus the options on the future. So I think one of the drawbacks to trading ETF options is that those options are American style, physically settled. And why this is an issue is a lot of people, like corporate bond portfolio managers, want to overwrite, right? They want to sell HYG or LQD calls to increase the yield in their portfolio. But because these are American style, physically settled options, there's a very significant risk actually of having your underlying being called away because these, they pay high dividends.
Right.
Whereas if you're trading options on futures, the futures are based on a total return index. So there's no dividend, there's no dividend that needs to be paid out. And second, the options on the futures, they're essentially cash settled. So you don't have that call away risk that you do with ETF options. So I would say for all of these reasons, we're actually very excited about the product. And we're really kind of hoping to get that off the ground.
Yeah. So I just think it's great for people that want to go and trade like credit spreads. And you go, you buy, you sell this, like, let's say you want it to be short credit. You go sell the high yield future and you go buy the equivalent duration of the treasury. And boom, there, Bob's your uncle, you're off to the races, and you have a very efficient way of being short credit that in the past, you needed an ISDA and all sorts of fancy stuff to do. Now, the trouble is that we haven't got enough people trading it. There's not. So why don't we tell people the symbols and where they can find it and just a little bit to help them along on here?
Yeah, sure. So the ticker for the investment grade corporate bond futures is IBIG, iBox IG. You can think about it that way. And the high yield is IBHY, iBox High Yield.
Oh, there you go. Now on Bloomberg, they're slightly different. It's IBY.
Yeah, I think they're. Yeah, there's like, because you have like the first month, like the front month future, and then the second month. So like the tickers are a little bit different, but like those are the two family of.
There you go. So if you want to see them on Bloomberg, you just iBox space future and they'll come up, and there we go. All right, Mandy, what we always like to end with is our 3 questions. Let's start with, what do you think is the hardest thing to do in trading or investing?
I mean, not to be facetious, but I would say, the by far the hardest is obviously, consistently to either make money or outperform your benchmark while minimizing drawdowns. But maybe, at a more macro level, I would say what is, sometimes very difficult is that investors tend to get too wedded to a particular like framework or narrative to kind of into how they think about the world. And when that breaks down, they're not prepared or nimble enough to adjust to the new reality, right? And it's not just investors. You can think about like the Fed, post-COVID being too stuck in their old framework about thinking about inflation and being totally unprepared for the new inflation regime that we've been in. But you can also think about investors who, post 2021 got too wedded to this whole, persistent inflation. Inflation is going to be the big risk for the next, decade, and weren't really prepared for, the immaculate disinflation, if you will, environment that we saw last year. And, hence, the big chase and going into year end for people who are not positioned that way.
You're so right there. And one of the things that you mentioned earlier is you said you kind of highlighted the fiscal. and how that changed the economic kind of landscape. And I feel like a lot of people still haven't accepted that. All right. Number 2 is Don Cox used to say that you shouldn't invest on what's on page 1 today, but what's on page 16 on its way to page 1 tomorrow. Do you have any trades that you feel would get the Don Cox seal of approval?
So with the caveat that, at the CBOE, obviously, I cannot recommend specific trade ideas. Maybe I will rephrase that question in terms of, instead of like, what's the next big trade, to one of like, what's the next big risk, or what is the risk that people are not focused on that could move markets? And let me just, without, like, obviously I can give you my personal take on what the next big risk is. But one thing I do want to actually point out, I think is really interesting, is that over the past year, we've gotten to see more and more people start to think about that unknown risk that could really shock markets. And you're seeing it in the VIX options market in particular. So one of the things that's been, I think, surprising to a lot of people last year is that as the VIX has declined, VIX option activity has actually picked up. And last year was a record year in terms of VIX option volume. And almost all of that was coming from the call side. So people buying upside calls in the VIX as a hedge for that tail risk. And, you think about, well, why did it happen last year and not in 2022? Well, 2022 was the known risk, right? The known risk of high inflation and Fed policy. But now people are now starting to think about what is the unknown risk that could move markets. So I just want to kind of point that out because, I think that's interesting that there's now more attention and more being priced in for that unknown relative to what we saw, in years prior.
That's awesome. I like that. Ted Seides from Capital Allocators often asks his guests, what is the kindest thing someone has done for you to help you along with your career? I'm going to borrow it from Ted because I think it's such a great question. Do you have a particular person or event that stands out for you?
In my career, honestly, there have been so many people that have been helpful, and, been mentors along the way. But probably the person that has the biggest impact was my first boss at Credit Suisse, right? So I started that job fresh out of college, wide-eyed, bushy-tailed. And, he was just such a great mentor, teacher, and someone who was, not just, super smart and really good at teaching, but also someone who was very good at developing talent, and not just with me, but with other people on his team, really kind of seeing what someone is good at, the skill set that they have, and really giving them the runway to excel and to succeed. So that's been like, I think the one person that really stands out, but along the way, there've been so many people that's been helpful to my career.
Do you want to call your boss by name?
Oh, sure. Ed Tom. He's now a PM at Ellington. Yeah. Okay. He's a great guy.
Well, thanks, Ed. That's great for you to be really kind. Okay. We're going to end with the last question. You get to get Ed Harrison came up with the question I'm going to ask you. And here we go.
If you were forced to do one sport every single day and you couldn't do any other sport and you could only do this one, but you had to do it every day, which one would it be?
Oh my gosh. So again, with the caveat that I'm like maybe the least athletic person on the planet, and certainly the worst, hand-eye coordination. I personally don't think I should be playing any sports, but if I had to pick one, I'd probably pick basketball.
Oh, really?
And that's because it's I like how fast-paced it is. I like that it's a team sport. Again, if I'm gonna have to do it every day, I want to do it with other people.
That's true,
right? I feel like if you're doing a solo sport, I'd probably go crazy a lot faster.
There you go.
That's my answer.
But you did not play on the Harvard basketball team?
Oh my gosh, I'm 5'5", so no, no, I did not play basketball.
And do you have a question for our next guest?
Sure. Again, keeping it maybe on the lighter side. So I personally love to travel. And so I would love to know from our next guest, what's the best place that you've been to, or what's kind of on your bucket list of places to go?
That's a great question. Listen, Mandy, why don't you tell people where they can find more about you, the CBOE, all that good jazz?
Oh, yeah, absolutely. So you can actually subscribe to my distribution list. If you just Google CBOE Mandy Xu Market Intelligence, there should be a link, a website. You can find the links to my latest pieces and also a place to sign up for, my distribution list.
And I highly recommend everyone do it. That's how I found Mandy. And I see her on Bloomberg all the time. I get to hear her great insights. And I just appreciate you spending some time with us. It's been very kind of you. And thank you very much.
Oh, thank you for having me. It's been a pleasure.
Thanks. Take care. All right, Patrick, time for talking charts.
It is.
Got for us.
Kev, It's been 2 weeks, and actually an interesting start to the year. But let's quickly just bang through the top 3 things to watch. So last 2 weeks ago, we were watching, obviously, whether there would be new trends emergent in the new year. And well, right now, not really. I mean, a lot of the major trends that have been in place are still intact. But we can, when we get to the charts, we can talk about timeframes and a lot of the major news that could potentially be trend changing in going into February. But number 2 was inflation, and really, CPI came in above, PPI came in below, and it really didn't move the markets. Was there something you had to take away from the inflation numbers?
Well, I do think it's interesting that CPI didn't move the bond market more because it was hot. But as you noted, the next day PPI was light. As an aside, the PPI is the input for corporations and the CPI is the output, meaning the stuff that they sell. So that's actually positive for the profits. Obviously, it's not that simple.
Yeah, but month over month is useless information.
No, listen, I'm just saying, in general, like that's actually what you want to see.
Yeah.
If there's going to be inflation somewhere, you'd rather it not be in PPI. You'd rather it be in CPI.
Absolutely. And the number 1 thing that we were watching was the jobs numbers. And I mean, in the end, the jobs numbers aren't showing a recession yet.
It's funny, actually. You had jobs as number 1. I forgot that, actually, even though that was a week ago.
Yeah.
Right. Yeah. No. Listen, the jobs we're a long way away from that. Like the Somme rule of the recession getting triggered. There's no signs.
No signs.
I shouldn't say there's no signs because if you're a real
jobs, no signs in the jobs numbers.
Well, if you're a real employment nerd, you actually can find signs that it's loosening up a little bit and it's not as tight as it's been. But there's no signs that, kind of on a grand picture, that there's any real weakness coming.
Let's put it another way. The markets didn't give a shit.
Well, that's a good way of putting it.
Right. Let's talk about the top 3 things to watch in the coming weeks going toward the tail end of the month. We have global PMIs coming out. Obviously, this has been where the economy has been contracting. While we haven't seen things like jobs numbers crack yet, we continue to see a lot of PMIs trading under 50 and in a contraction phase. And it'll be interesting to see whether the trend continues and whether they remain as weak as they are. Is there something specifically you're watching on any of those?
No, they've been weak for a while. It will be interesting to see if we get a bounce. Like, did Christmas come and did we get an uptick? And is the kind of slowdown that we've had, going to bounce? I think it'll be interesting to see if that's the case, but I'm not holding my breath.
All right. Number 2, we have the earnings season. And I put it specifically guidance because I don't think fourth quarter earnings themselves are going to be a surprise. But this is the window going into the new year where a lot of the companies give guidance as to what they see forward for 2024. And it'll be really interesting as we get into the pig in the python of the earnings releases in the coming week, whether or not it changes the sentiment of investors and their outlook.
I don't have anything to add. Earnings is always a fun time. There's obviously a lot more alpha to be created on individual stock trading when we get into this period. It'll be interesting to see if you kind of mentioned the fact that you think that the actual earnings aren't going to matter. I'm not as sure as you are about that. There's been a lot of increased expectations, and it'll be there'll be the possibility of some companies missing earnings expectations. Patrick, I'll take the other side.
Yeah, okay, but a couple of companies missing, but generally, when you're looking at the S&P 500 earnings per share as an aggregate, I don't think that this is the quarter that there was going to be a big downdraft or something like this, or even a big uptick. I don't think. While there could be definitely individual companies that are missing, I think the guidance and the way the earnings go throughout the year is actually going to be far more important. But obviously, certain companies are going to be, there's always the earnings hand grenade pins being pulled, and something always starts to diverge. I mean, there's been certain markets like home builders and financials that have been running so hot. It'll be interesting to see whether or not things cool off once all these different areas start to report.
But I look at like the rolling 12-month EPS, And like if we go back to last summer, the EP it was at 220. Where are we here? 225. We're now at 243. There's been a lot of like increase in expectations.
Yeah,
and I think there's more of a chance that rolls over than you do, but we'll see.
No, I think it rolls over. I just think that it's more going to be a story for the year as opposed to all happening this quarter. It's my call. Anyway, We'll see. Number one, we have, even though the FOMC meeting itself is going to be after our next show, so that's going to obviously be the number one next time we record this, but there are all the global central banks coming out with their monetary policy statements, everything from the ECB to Bank of Japan to Bank of Canada, etc., that are all up to bat here in the next 2 weeks. And obviously, the dovish pivot that Powell, indicated, the big question, will we start to see other central banks around the world change their tones to being equally as dovish, or will they stay a little bit more tight and allow the U.S. to sort of lead the way on the easing cycle? What's your thoughts?
It's tough. It's tough because I think that I think that a lot of these banks are going to be loath to go ahead of the Fed, even though they should be. Like, let's take Bank of Canada. They should be lowering rates. Whether they will be or not is, they'll probably make a mistake. ECB, Same deal. They should be lowering rates. The U.S. is the strongest economy out there. They should be the last one, and yet everyone's sitting around waiting for the Fed.
Right. All right. Let's talk some charts, Kev. Let's start off. Obviously, let's just talk equity markets, right? And the first thing we're going to do is just touch on this S&P 500, and it's trading right at its high of the year. Of last year, where will it be a double top, or will there be one more impulse higher in the markets, is something that we're going to find out and discover here in the next few weeks. And we have a lot of news that could drive it, right? And there is a technical measured move that does measure all the way towards 5,000 on the S&P futures. It's about 4,900 on the cash index, just a little bit above that number. And so there is room for this to go. The other thing to observe is that generally the price action remains quite accumulative. Higher highs, higher lows, dips are being bought. We haven't yet seen at least on the index itself, any price action that indicates that the bears have regained control and that some sell-off is imminent. Even arguably, even the divergence signals are starting to diverge, but nothing that would indicate something is imminent anyway. But we're holding up along the highs, and it's one of these things where we're definitely in the 8th or 9th inning of this advance, but it can first go higher. At least there's no sign yet. Nothing has cracked this market to suggest that a distribution cycle is underway. But at the same time, it's kind of a bad trade to go long here, because the easy money's already been made. And it's one of those things where it's like, if you get in the market here, fine, you could be up for a couple of weeks, and then suddenly in one day you're going to be underwater.
You know that line about the easy money's already been made?
Yeah.
I want to know the next time it's easy money.
Well,
I know what you're saying, but I'm just saying that I find that comment a little bit disingenuous, because a lot of people will say it, but they just
let me rephrase it. Let's reframe it, okay? Let's look at it from an asymmetry perspective. Ultimately, let's say an average S&P advance is 700-800 points on an impulse. Well, when 600 of the points have already been made, and the average is an 800 move, then you have to recognize that there's no asymmetry in pressing for the last little bit, because you're going to inevitably get caught in a correction.
I'm not disagreeing with you, Patrick. I'm just pushing back on that it was easy on the way up.
That's when I say easy money, that's what I'm implying. I didn't mean it was easy as in like everyone saw it. I'm just simply implying that even though the trend is in your favor of it going higher, it's a bad proposition to put in new money to work at these levels. You almost need to wait for some sort of a pullback in order to reset that asymmetry. So, Kev, when we go back to the breadth indicator of looking at the percentage of stocks above their 50-day moving average on the New York Stock Exchange, 2 weeks ago when we did our last episode, it was at the 87 level, which was the highest reading in 3 years. It was so it was an incredibly overbought and a very broad market rally. Since then, it's dropped to 75, and so we already are seeing the breadth slowly backing off. But what is interesting is when you look at the equal weight S&P 500, that actually has still stayed in line with the main S&P. Maybe it's not right back up to the highs, but we haven't seen there be a huge divergence between the market cap weighted versus the equally weighted index. But where the divergence has been is in the small caps. And the small caps have been one of the strongest performers throughout November and December, and almost like an 18% rally, or even more. Well, let me just double check what it was. It was never mind, a 27% rally in 2 months. They had an extraordinary run. But when the correction happened several weeks ago, we had this correction of almost 150 Russell points, and it hasn't rebounded like the other markets. And so what we're seeing is slowly we have less and less participation in this. And obviously we saw NVIDIA and a whole array of those Mag 7 stocks ripping. So we have this scenario again where the largest cap stocks are literally holding up the indices again, while we're slowly seeing some broader selling developing in there. And so I don't know whether this is enough for me to get bearish yet, but it is at least the first crack that we have seen in what was a pretty epic 2-month run on the upside.
Yeah, it sounds good. You're absolutely right that small caps have been disappointing.
All right. So let's actually talk about the dollar here for a moment. And the dollar bounced over the last 2 weeks from after obviously Powell's pause pivot. The dollar went through a substantial 4-point drop on the downside, and since has bounced 50% of that sell off back, a typical 50% retracement. But the question now is this just a typical bounce like we saw back in December or any of these other little rallies that turns around and has the dollar sell again? Or are we going to see the dollar actually start to bottom here? Now, that it is incredibly premature, but I think these central banks that we put number one on our things to watch are going to play a big role in this, because right now, obviously, the dovishness of the Fed and the U.S. Impacted the weakness in the dollar. The bigger question, will we see other central banks now counter that with their own dovishness of some sort? Now, I don't have an answer as to whether I think it's going to happen or not, but watching this next dollar move, I think, is going to be rather important.
You know what's interesting, Patrick, is we've had some geopolitical tensions, and going into this weekend, who knows what's going to happen? But for the first time, we had U.S. and Britain bombing the Houthi rebels or whatever it is, and yet the dollar really didn't get that much of a bid, considering.
Yeah.
And I one of the things that I always watch for is that when something doesn't do what it should do under a certain circumstance, oftentimes that means that there's another, like the opposite move is coming.
I don't think that that's a significant enough of a military operation to be dollar impact.
Well, I'm not so sure I agree, because I think in a U.S. dollar bull market, they use any excuse they can to buy it. And so the fact that they're not using that as an excuse leads me to think that maybe we're not as in a bull market as we think.
Okay, well, listen, you can say I think sticking to the squiggles will work for me better than speculating on that. But right now, the one thing I will say, going quickly back to that dollar chart, you have to respect the prevailing downtrend if they can't beat 103. The 102.5 to 103 is just a typical Fibonacci retracement zone. And if the dollar weakens from here, then the pattern of lower highs, lower lows, and the prevailing downwards channel is the dominant one. And so you have to stay on the weak dollar storyline if they can't clear that 102.5, 103 zone. And so I'll be in your camp for that side of it. Like, there's nothing indicating that the dollar has done anything bullish yet, and I wouldn't want to lean on that or even position for that yet.
That's good. I like that technical analysis, buddy.
So, well, the interesting thing is that the bounce in the US dollar against the yen is at a similar moment. So that move on the downside from 152 to 140 was just an extraordinary drop in 2 months. And you got your typical, 50% retrace. You bounced, and half of it was retraced back on the upside. And this is actually a moment where you find out whether the prevailing new trend is down for the dollar. Because in theory, if we see that this is all the US dollar bulls have against the yen, then we should see the currency failing at these levels here and start rolling over. It doesn't have to happen imminently, but if the US dollar decline against the yen is the dominant trend, you shouldn't see that much more upside on the dollar against the yen here.
I got it. Actually, I almost went to cover a little bit because, as you know, I'm always long yen. And I was like looking at it and I was like, you know what? It's like this isn't the spot to do it. And I completely agree with your analysis, which generally means, therefore, that I didn't cover any, that the US dollar is going straight up and the yen's going down.
So let's talk about Bitcoin.
No.
Now,
seriously?
I went, yeah, but listen. I went and told my members yesterday and the day before. I said, no different than cannabis or any of these other stories, or like the Russia-Ukraine war with oil, there is the buy rumor, sell news effect. And I did not say I knew that Bitcoin was going to go down. But one of the things I was just simply saying is that this is a common thing in the market, which is everyone buys in anticipation of this big event. And then on the announcement, it becomes a key reversal moment. And it's funny how Bitcoin literally pop and dropped to the day for the announcement of these new ETFs. And while I'm not trying to say that means it's all downside from here, but it's interesting that reversal happened literally on the news.
Okay, so I agree with you. And that is, you're right. It was a classic, like, buy the rumor, sell the news. Do you know Tom McClellan?
Yeah.
Okay, so he's the editor of the McClellan Market Report.
Yeah.
He's got a great tweet, and it's a little long, but I think I'm going to, if you don't mind.
Yeah.
I'm going to take the time to read it, okay? He says, perhaps the greatest case of front running, which did not work out well, was gold in 1974. Back in 1975, Americans were finally allowed to own gold bullion again. President Roosevelt, back in 1933, had made it illegal for Americans to own gold bullion, and everyone had to sell their gold to the government as a way to push more dollars into the economy and got everyone spending and investing again during the Great Depression. Blah, blah, blah. Okay. President Nixon finally took the U.S. off the gold standard in 1971, mostly because it was indefensible. This guy seems like he's one of you guys, Patrick. Running trade and budget deficits meant that the U.S. could no longer afford to exchange its gold for dollars, and Germany departed the Bretton Woods Agreement in May 1971, refusing to exchange D-marks for dollars at the specified 4-to-1 exchange rate any longer. By August 1971, economic pressures were so great that Nixon closed the gold exchange window, implemented wage and price controls, and imposed a 10% tariff on imported goods. Nixon's move on gold also set the stage for eventual restoration of America's rights to own gold. Americans' rights to own gold, but not right away. The restoration was set to go into effect Jan 1, 1975. The rest of the world knew about that and figured that all of this latent demand from Americans would suddenly be able to own gold had to be a bullish factor. So they tried to front run that demand, bidding up gold prices in a big way all during 1974. By December 1974, gold on a monthly closing basis was up $185, a gain of 330% over when gold was trading when Nixon ended its convertibility. But unfortunately for those front runners, the anticipated surge in demand for gold from American investors did not materialize as the rest of the world was hoping, and gold went into a big decline. It eventually lost 41% by the time of the August 1976 low, which led to one of the greatest bubbles of all time in gold prices during the late 1970s. I thought that was interesting.
Wow.
I didn't know that story. I didn't realize that they had announced it and people had run it up, and then when it
I didn't know that either.
Yeah,
and
it's a great story.
but you know what? It's one of the truisms in the market. Like ultimately, everyone thinks they're trading an edge, and it's funny. But the buy rumor and then sell the news event seems to have an incredibly great track record.
Oh, 100%. You know what? I think that Mark Fisher said it best. He says, if it's obvious, it's obviously wrong. And so I just thought when everyone was buying in anticipation of selling to this BlackRock and all these guys, and what I don't understand is like, is there really that much demand for this thing by like these institutions? Like if somebody,
I kind of think that everyone that wanted to own Bitcoin already owned it somehow.
It's not like all of a sudden someone's going to and say, oh, you know, now that it's in an ETF form that I'm finally going to buy it all. And then the other thing is, Patrick, why would someone buy it all the day that it gets put into an ETF?
Yeah.
Right? Like you could argue that maybe that they're over the next 6 months are going to buy it, but why that day?
Yeah.
So I'm with you, Patrick. Well, you know me, I'm always thinking this thing bits in
no. But anyway, I just thought it was interesting that way. Okay, so what I wanted to move on here, and we should talk gold. Obviously, I'm doing a special gold webinar, but let's actually first just talk about this because obviously gold, I mean, if we put it on a monthly chart and really see, like gold is attempting to break out to an all-time new high.
It's the most hated, best-looking chart out there.
Exactly. Nobody wants to touch this thing with a 10-foot pole.
You're too busy buying the bits in the sky.
And you know what? You obviously have a lot of gold thesis. You've been talking about this for 6 months, and you know, just like your bond story, you know, you're just serially early to the trade. Premature accumulation. It's a side effect. But the thing is that I still think that the environment is there in the coming years for a really big breakout in gold. And this kind of multi-year sideways purgatory along the highs that it's had has every opportunity to bullishly break out on the upside. And obviously, you've written about this. I know I wouldn't mind you kind of going over the thesis that you put in the Macro Tourist letter, which, by the way, is an amazing newsletter that everyone who is not subscribed to must subscribe.
You're just feeling bad because you asked me to plug your thing at the beginning.
But well, listen. Scratch my back, just scratchers. But listen, you have a gold thesis. Obviously, one is that the central bank buying of gold. Like, why don't you kind of talk us through that thesis?
It's not that complicated. Everyone's been sitting there looking at the U.S. dollar, looking at the real rates rising. Both of those have been rising, and yet gold's been going up. And everyone's like, oh, you know, rates are so important. The U.S. dollar is so important. But meanwhile, gold's going up, and it's simple. The reality is that central banks are buying more of it. It started in a big way once the U.S. confiscated the Russian gold and the Russian foreign exchange reserves, not their gold, because if they own physical gold, they can't actually confiscate it. And that's ultimately the issue, right? If you're sitting there and you're a central bank, let's just take if you're China and you have trillions of dollars of FX reserves, you're holding them in U.S. treasuries, and to some extent, if something goes wrong and America decides to zero your balances, they can do that. Like everyone thinks that there's not everyone, but too many people think there's somehow nothing stopping America from, you know, zeroing China's FX reserves. There really isn't. If they wanted to, they could do it tomorrow. It's nothing more than just an entry in a spreadsheet.
Yeah. And
so if you're sitting there and you're China, I don't see how you don't look at this and say, this is a real risk. I can't eliminate this risk, but at the very minimum, I should be diversifying away from it. And I think that they're going to be on the gold bid for a long, long time. because
All right.
and that's ultimately it. And you just look at the central banks; they've been accumulating for the last few years, and that has meant way more. If you go look at the regression analysis is against the U.S. dollar and against real rates, they've all broken down. The gold is no longer trading based upon the currency and the and rates. It's trading by central banks, and that's all that matters.
Right. And so on that thesis, obviously the other element is that the gold miners, though, have not at all participated. Like gold itself, well, it's got the benefit of all the central bank buying. But here the gold miners went through some extraordinary, like even just in the last year, the peak to trough sell-off was a 30% decline. While we're off of the lowest levels here, these gold miners are getting no love. And obviously, when the miners don't perform, there's everyone, well, they have so many costs and they're so poorly run and and all the other stuff that they talk about. But, these miners ultimately will get love when gold starts to shine again.
When they start making money, they have to make money. And not only that, Patrick, I think they have to buy. Think so. They have to buy back their stock.
I am going to push back on you. They don't need to make a penny. All that needs to happen is gold just needs to start going up.
But I'm not sure. Kev. Oh, so you're just saying the momentum once gold has been going up. And yet nobody cares.
No, but listen, but no one cares yet. But the point is that's the way the markets work, Kev. Kev, nobody cares until everybody cares, and then everyone cares all at once. This is the way that it's always been.
I won't disagree with you there.
Right?
Yeah.
And the thing is that nobody's given a shit because there's no momentum here. No, what kind of a money manager, a prop trader, or anyone is going to want this dog shit on their books when it's acting like this? Ultimately, they only give a shit when it starts making money, and then they have to have skin in the game. But like to use, so I just recently did the kind of analysis that originally was inspired by Grant Williams, who did it first. And so I want to give him credit first, but just calculated the market capitalization of all of the gold mining companies in the GDX. And the market cap of all of these companies combined is the same market cap as Merck.
Yeah. It's such a great presentation that Grant did that one.
Yeah.
The trouble was you complain I'm too early.
No, but
a decade too early. That might be a decade ago. We made that great presentation.
Oh no, he already had a good bull run in the gold miners. It's like this is the 2.0 version of it. We've already had a bull and bear cycle already since he did it. But the point is that imagine that same argument again, which is let's say even 20 or 30% of all money managers out there just simply said they want a 1% allocation to gold miners because gold is breaking out. It's a new gold bull market. There isn't enough gold miners to go around. It doesn't fucking matter if they're making money or not making money. People are going to buy it just because this is where the sector is and this is what's working. And they're going to buy it irrespective. And the thing is, these miners have been left for dead. And if gold's going to go, then you're able to still buy these at substantial discounts to where they were trading even just a year or two ago.
Yeah. Listen, I completely agree. Then the other thing is, Patrick, think about like their inputs, the input costs. Like, so we know their output, like what they're selling has gone up in price, the gold, but think about their input. The biggest input I think is energy.
Like, yeah.
Right. They take a ton of energy. And so what's happened to the price of oil? It's collapsed.
Yeah. And that's a factor, but I just don't believe that kind of fundamentals will matter when gold really goes.
Stop talking to me about fundamentals. It's all momentum, baby.
Stop that shit. What are you doing? No, but the interesting thing, I mean, I know you pushed back on this idea before, but it's not your favorite part of the theme. But I also believe that we're like going to be in this amazing new easing cycle. Not yet. I think everyone's a little bit ambitious in terms of how fast the central banks around the world start easing. And I still think there's a very good chance that there's going to be substantial volatility and some sort of an economic slowdown, if not a recession of some sort. It doesn't have to be anything nasty. But on the other side of that, is going to be a central bank easing cycle. And historically, that is a period where the US dollar is in a bear market. And that is the period where gold does its best. And really, the whole theme of my webinar is really just about how to leverage and maximize your returns when that cycle plays out. So whether it's a combination of central bank buying and whether it's a combination of where we are in the monetary cycle and whether it's the valuations or fundamentals or non-fundamentals of these gold miners, I think that there's an extraordinary opportunity, right? And, everyone says these things have been left for dead. They've done nothing. But I remember for 5 years when uranium stocks did absolutely nothing, and look at the way people think about them today, right? It's if you want to be in the early stages of something, you have to get in before everyone's talking about it, right?
That's great. That's what who is it? Jim Grant. He talks about the fact, he says the key to great investing is buying something before everyone else realizes it's a good value.
There you go.
Right.
I wouldn't call it value though. But anyway, let's talk crude oil for a moment. And the observation I just wanted to touch on crude oil is that it stopped the sell cycle. Now, that doesn't make it a new bull phase. But what we've seen, at least in the last month, is that every time crude oil is sold, buyers come in and immediately scoop it up. It gets sold, and buyers come in and scoop it up. And that means that a sell cycle, which is just by price action alone dominated by more sellers than buyers, and they're aggressively hitting the bid, taking lower prices to unload stuff. We've now reached a point where at least we're finding some sort of a fair value zone for oil where buyer and seller equilibrium is coming in. Now, the last time this happened back in May and June of last year, it took 2 months of this trade range stuff. So that doesn't mean something is imminent. But I think that increasingly, beyond some double bottom retest of crude oil where it temporarily drops to 66 and then pops back up, beyond that, I think that oil could be bottoming here.
At the risk of doing crayons with Kev too early, I have a very simple, like stupidly simple trend line that I've drawn on the chart. And if you look at it, I thought it was going to break today. It looked like it this morning it had broken out of the trend, and then it closed right there.
Save it. Well,
no, it's not that one because I'm not going to. Okay. I got another one for crayons with Kev, but that trend line has been down and it's been pretty consistent.
Yeah, but you know what? You could use a trend line, but the other thing you could do is a 50-day moving average. And the 50-day moving average. Notice the breakout in July when it got above its 50-day. Point is that there's no guarantee that the breakout is imminent. I would not be shocked.
No. But what I'm saying though is, I would argue that until it's done that, it's tough to even be long.
Oh yeah, no, but yeah, you could, if you're willing to endure some short-term volatility and you're willing to be patient. Yeah. But generally, you definitely cannot be overweight this thing. Right? Well, you can start poking around with positions so you have some skin in the game in here. But definitely, you want the trend to shift in your favor to start being more aggressive on your sizing.
I've been for the last month just saying until that trend line breaks, I'm not owning it. I thought today was the day it was going to break. Literally this morning, it was above my trend line. I was saying, okay, this is it. Time to go buy it. And then by the end of the day, it closed back down below my trend line. And I was like, well, I guess I was good to not buy it. But I am going to go the other way, Patrick, because I'm probably on a little bit more on the side that we're due for a snap. I'm just not going to, I don't know how to time it except for that simple trend line is headed lower. And until that breaks, I'm not buying it.
There you go. Let's talk uranium.
Oh.
U3O8 contract, $104, up $7 today. U.UN up $2, up 7% to $32. One of the things, like I had a measured move up towards $28 to $30. That was the completion of my target move on the upside. And I said to my members, I said, either one of two things happens here. Either this is where it's going to pause and mean revert, or we're going into a parabolic bubble blow off. And rest assured, when $30 gave out on the upside, this thing is starting to melt up.
Yeah. Listen, the greatest bubble rider of all time is called that, and he's still long AF.
Yeah.
He's Cuppy's a machine. He never.
Yeah. Well, listen, I've been long the uranium too, but it's been, what a ride, and even the individual names. Like, take a look at this rip in Cameco, like from $42 to $50 in a span of 3-4 days. Just like the entire uranium space is on fire all of a sudden. Just working very, very well here on the interim. And so nonetheless, those that are long uranium, congrats. It's been a beautiful trend. The other one, let's talk to Widowmaker quickly. What a bounce in that gas. I mean, obviously, whenever you have a sell-off as significant as we saw there, I mean, it was from almost $4 down to like $2.25 in a span of several months. It literally earned its name as the Widowmaker for anyone that was betting on a bottom on that gas back then. But just as violent as the drop was, this rally is just as violent on the upside. This is honestly one of the most volatile assets I've ever seen. It's incredible. It makes Bitcoin look like a conservative dividend paying stock.
That's why it's such a good idea to sell volatility on it.
Yeah. Go naked on the call options. Why not? Oh my God. Just quickly, bonds. The 10-year bond upticking. What is interesting, Kev, is the 2-year bond ripping to a new high, 30-year not so much. Point highlighting here, and I'd love your comment on this, but the 2-10s are steepening, but this time it's a bull steepener. What do you make of this?
I don't know. I'm confused by today's move on the 2s. I'll be honest. I don't.
Overall, obviously, we had a bear steepener, and I know some of our listeners don't know the difference between the two. But basically,
selling them short, they all know exactly what it is. But you just pretend like you.
No. All it is that we're looking at the difference between short-term interest rates versus longer-term interest rates, and a bull steepening is where short-term interest rates are dropping faster. And a bear steepener is when long-term interest rates are rising faster. Is that I'm bang on, right?
Actually, I don't know how to define it, because what happens if one versus the other? Like it's just whether which side has to be in the bull or bear market.
But which of the bond moves is the one that's moving it? Right? And in this case, the 2-year is the one that is rising as the 2-year yield is dropping, while the longer bonds, the 10s and 30s, are doing nothing. So it's a bull steepening.
The 2s are just unbelievable, though. I don't have a clue why they, like, I can tell you why. Like, I can say, oh, the PPI came in light and that's why. And now all of a sudden they're pricing in more cuts.
Or what if they see the recession?
But... yeah, maybe.
Bond traders are some of the smartest traders in the world. What if?
Okay, so let's stop and think about this. What was the 10-year in? Let's just go look here.
Okay,
don't give me this crap that they're the smartest.
Okay, fine, all right. I take it back because I don't want to hear your rant. I admit I'm wrong. Please don't make us listen to this. Okay.
In 2021, there's a bull 2021. The 10s were 139, and trust me, lots of bond bulls were telling you that they're smarter. They know there's no inflation coming. There's no way rates are ever going to go above 2. You got to buy 10s at 1.5 because this is a great opportunity. So don't give me this. Like this idea that the bond guys are somehow so much smarter. I'm a seller.
Right. Okay, but anyway, it is a bull steepening. And we're now only 20 basis points from the curve being flat. Is there any you have anything you think it's going to go? Are you
I'm a huge
long the steepener?
Yeah, you know me. I'm always have that trade on. Like it's one of my favorite trades. But
have you been adding to it, or are you just leaving it now?
But one of the things
you just at the bottoms loaded up and then you're just holding.
But one of the things that scares me is I'd rather see it the other way, because The reality is they're just pricing in the twos are leading, and the twos now have what, like 7 cuts priced in for this year? Like 7.
Yeah, the 2-year yield is a 4.14.
Like that's a lot of cuts. I don't know. It's
well, no, 4.14, and we're at 5.25, so that's only 4 cuts.
No, but that's the twos, and you have to realize like the implicit in there is whatever the Fed funds is going to do. They've already got the cuts, and then it going back up afterwards.
Right.
So
okay.
So like it feels to me like the twos are way ahead.
Yeah.
Like, do you really think that they're going to cut 7 times in 2024? I feel like if they're going to cut 7 times, they're probably going to cut 15 times.
Yeah.
Like it's not going to be 7. Right. And we've talked about this before about the probability distribution of it, stuff like that. So I get it. But it's just what I worry about when I go and I'm long 210s, like, is that implicit in there is the fact that the twos are now all of a sudden pricing in that. And if we don't get a collapse in the economy, then they're going to be a sale.
Yeah.
And I just hope that the 10s are even a better sale, which I do think so. Like I actually really,
I think you're overthinking it, dude. Okay.
Yeah.
Like, in the end, I think the bigger economic cycle is.
I know you think the world's ending and you should always own bonds.
What do you mean? I don't. Did I say that at any point?
Well, no, but you're excited about this.
You're like
this
literally you're
this bull cycle in the bonds.
I think that there's going to be a recession. Yes.
Yeah.
Okay. But that's not the world ending. Like recessions happen, dude.
That's true.
Okay. So what I wanted to highlight is one of the things that I totally think is mispriced is this rally in high yield bonds. And while I get it that maybe they're not going to collapse and maybe we're not going to have a bond crisis, but honestly, this is when you think of where we are in this cycle, it just doesn't make sense for credit spreads to be as narrow as they are. And the fact that we had this, like obviously junk bonds correlate highly to equity. And like, what was it? Am I correct when I think that the number was like 80% correlation or some crazy high number like that?
I don't know, but it makes sense.
I don't know what it is, but it's a number somewhere in that. I remember hearing at least that number before. The point is that they obviously ripped because the whole stock market ripped. But I think that this is silly. Now, while I don't necessarily think these have to collapse, them coming right back into the bottom of that trade range, I think is a story for 2024. We'll watch and see.
I have trouble like buying credit here as well.
So
like 338 basis points on like the high yield Bloomberg high yield OAS. Like that's like, where was it? The lowest I see. I'm just looking at this chart. I saw 242 in 07, right before the disaster. And I saw 270 in 2021. 2021, I almost understand. They were repricing, like the Fed was buying every corporate under the sun and refinancing everything. So that one seems to make sense. So if you take out the 2021 and then you look at 2007 and you say, well, they were just on drugs or whatever, then you look at it, 338 is actually pretty tight. It just doesn't seem like the proper risk reward at this point. But I think, though, Patrick, one of the things you have to remember is that on an absolute level, the fact is that these are now these high yields. So what is this? This is a 5 years, right? Like generally the duration. So 338 plus, let's look what the 5-year rate is. So 5-year is 383. So like you're getting 7% for 5-year bonds. And like, that's why people are buying them. It's not that far off at the 8% they're expecting on the equities.
Yeah.
And I think that's really what you're experiencing. I think that's why corporate credit spreads, or sorry, not why. One of the reasons that has been helping it is that a lot of money has been flowing into it. Anyways, I'll let you go on about the next thing.
Let's talk about Nikkei.
Ugh.
Because, no, listen, we've proved that the market gods allow us a hall pass once in a while, because we were both bullish the Nikkei. It was certainly had the all of the writing on the wall for it to make us look like fools. I mean, you were certainly pressing this as a trade. or at least the idea the Nikkei is bullish. And what a breakout we got in the last 3 days.
Yeah.
Like this is a legit breakout out of a 6-month trade range on the Nikkei. And usually these bull runs can last months. And so it'll be really interesting to see whether this has started another key advance.
It's not going to be that easy. They're going to make us sweat. It's going to come back and test.
Yeah.
It's going to make it come back and test.
Well, no. There's always market reversions, but a breakout of this kind of a trade range, unless this is a prairie dog, the most epic prairie dog, and this thing is back to 32,000 in a week or two, barring something like that, then this is a new trend. So even if there is a 50% retracement, we're trading back toward 34,500. It's still a breakout.
I'm not disagreeing.
Right? Of course, you buy dips.
Yeah, I think though the one thing that you can definitely say is that you should sell it against the U.S. This is a better thing to own than the U.S.
Well, what's interesting is, generally emerging markets. Well, we had the emerging markets ex-China relatively strong, but obviously emerging markets have been dogging it, and largely because obviously China has been in one of the most epic bear markets. Like it's the one equity market that has been divergent of the rest of the world very distinctly.
Yeah.
And it's been declined, but it's offset by some emerging markets that are doing extraordinarily well. Like, look at the way India continues to rip to higher highs. The Sensex has just been on fire. You take the Brazilian market, the Ibovespa, if I say that right, but it's had an epic run on the upside. Even the Mexico index has been doing well. Like some of these emerging markets are ripping, but China is dragging that broad basket down, like the EEM basket down, and creating that huge underperformance in that space. But outside of Japan, some of these emerging markets are just on fire.
You know what's interesting, Patrick? I saw a chart the other day about the ETF, emerging market ETF versus the emerging market ex-China ETF. And over the last year or two, the ex-China one has just been sucking up all the kind of inflows. And for the first time, it's actually larger market cap than the one with China. It almost feels to me like it's time to buy China.
There you go.
Nobody likes it. Like you'd be just.
I'm okay. This is where I think. There's two things. One, you're way too early because bear markets like that bottom, fine, maybe there's initially one reversion snap that creates a nice 10-15% return off the low, but then they often stay in purgatory for a year or more, establishing a bottom before a bull trend begins. While maybe you can start to speculate that it's reaching the bottom end of its range, it's just a terribly early trade to be already going long.
You're probably right. Think about it though. This would be the gutsiest trade. This would be like Maverick. If you bought China.
But why would you take the geopolitical risk?
Anyways,
if there's
just
one
second,
country out there,
I'm not trying to say I like this trade. I'm just saying this would be a Maverick move. Buy China, sell India.
I don't see the upside worth it. There's so many global markets
you
out
like
there
to
that
play
are
like
amazing.
Iceman.
Yeah. I'm a seller on Maverick here.
All the non-Gen Xers
right, buddy.
are like, what the hell are they talking about? Actually, that's not true.
Crayons.
All the youngins like it because the new Top Gun.
Exactly.
They don't know the original reference though because they don't watch the old one.
There you go.
Crayons with Kev. Let's do this.
Crayon. What chart do you want to
baby.
look at? XLE. Okay, so we have here the energy sector ETF.
I need you to kind of widen it out.
Which is primarily a lot of the majors.
Right. I need you to kind of like make it so I see
Zoom
more
out.
of the chart.
I'll do it on a weekly chart.
There we go. Look at this. Look at that bottom, like rising wedge. I don't know what it's called. It's just like, look at the lows.
What time frame? Like that?
Like
you want trend line from the very low?
From September of 2023. Just go along the
23.
lows. Yeah,
okay.
Just go along the lows there. Make that. There you go, baby. That's it.
And you think it's going to break on the downside?
No. That's like
That's a support line.
That's a series of higher lows.
You know what? The pushback there is that at any one downtrend, a trend line will always be tested before it's broken. And to me, it's about price action. And the price action on the XLE is still distributive in its nature.
No, but you're looking,
Every
you're
rally
looking
is
too
faded.
closely. Like, look at it longer term.
But the point is that
look at it longer term.
But what you grabbed a crayon, all right, and it's a pretty thick crayon, and you went onto a very big chart and you drew a big line, and you think that magically this price is going to stop there. What, like, you're the one that's chewing too much crayon, dude.
All right, there we go. I'm a buyer of XLE. I like it.
Listen, I actually think these energy stocks will turn, but that crayon line is not why I would be buying it. Right? Like, I'm not bearish.
I failed today.
Listen, listen. Your last couple crayons with Kev were good. This one's a fail. You're going to get an F on this one. All right.
Okay.
Listen,
let's do.
We lost Lena.
We
lost Lena from technical difficulties. So guess what? We're doing she's not saving us for no stupid questions.
I'll read them. Let's go. Okay.
All right. So go for it.
Here we go. Hello, all. I'll try to do my sultry voice. It seems that the big worry is that the Fed cuts rates too early. This would cause inflation to accelerate. I can't do it. I'm going to crack up. However, according to MMT framework, rate hikes result in increased inflation as the increased debt spending by the government adds money to the private sector. So would the Fed actually be making a smart move if they cut interest rates, as this could slow inflation by reducing the debt spending? I like this listener. This may also help the smaller businesses and keep employment strong as we near the maturity cliff for the corporate refinancing, and help offset the continued fiscal spending brought on by the Inflation Reduction Act that Kevin has been so vocal about. I would love to hear your thoughts on this. And if that does play out like that, is it time for Patrick to replace the Lacey Hunt poster with one of Warren Mosler?
Will not. I will not.
I completely agree. If the logic that raising rates actually might be stimulative to the economy, and if you accept that, then you have to accept that lowering rates could be contractionary. The only thing is, remember that that's only the government side of the equation. There is still the private sector money creation side of the equation that too often the MMT folks just ignore. And that's kind of one of my complaints. Although I agree with them about the way a lot of the government side works, I think too often they forget about the private money creation side. And one of the things that I might kind of push back on this theory is that over the last year and a half, as the Fed has been raising rates, a lot of private sector corporate CEOs and a lot of people have been very nervous about an imminent recession. They've been telling us there's going to be a recession for the last year and a half. And so one of the things is, with the Fed doing this pivot and maybe even lowering rates, and at the very least no longer raising rates, it might pave the way for some actual private sector money creation. So therefore, just when you're ready to say all that matters is just the government side of it, the private side might come back. And that's you know what? You're basically betting that the creditworthiness of the private sector is there, because in order for private sector money creation to happen, you need them to be creditworthy. But they are. If you look at it, like look at corporations, and if you look at the amount of their interest expense as a percent of their profits, or the expense or as a percent of their market cap, it's really low, even with the raises in rates. It can happen. So I love the logic. I just worry that the private sector might actually come alive. All right, here we go. Let's read the second question. Hi guys. I only discovered your show about 18 months ago, and I love it. Only 18 months ago. It is a must listen every week. Well, very kind. Thank you. I am trying to understand the futures market, specifically around U.S. Treasuries. I understand that metal and commodity futures are for some determined future price on a specific date. For example, gold futures are in a price per ounce for 100 troy ounces as a contract size. And at the end of 2023, the January 2024 price was $2,062. But then I look at the U.S. Treasury futures and I see that the contract size is 100,000, and for the March 2024 contract, it's priced at 112 and 29 seconds. Actually, it's not; those aren't. Those are for the Treasury T-note futures. Given that in the first week in January, the spot yield of the 10-year is just shy of 4%, I'm struggling to understand the 112 and 29 number either as a price or as a yield. Can you help? Please bring back the full show format every week. Brian. Well, Brian, that ain't going to happen, but we are going to help you with understanding how these things are priced. Patrick, have you got a screen?
No, you didn't send me anything.
I did send it to you.
Did it go to my junk? I would make sense that you went to my junk.
Yeah, probably is your junk.
Oh my God, you are in my junk.
Yeah.
Oh,
that makes sense.
Junk. Never block this sender.
Oh, that's
my
kind
goodness.
I wish I could offer you that.
I've never been
I wish I could offer
you
the same consideration. So, Patrick, what I've done here is I brought up what's called the cheapest to deliver screen for the 10-year Treasury note future. And one of the things that these listener needs to realize is that when you're looking at the price of 112 and 29 seconds, even though today it closed at 112 and 13 seconds, that is the futures price. But that futures price is based upon what's called the cheapest to deliver, meaning the bond that is the most efficient to deliver into that contract is what the shorts will deliver. And when you're looking at it today, it's the 4 7/8 of October 31st, 2030. And you might say to yourself, that's not a 10-year, and you're absolutely correct. That's actually just a 6-year. And that's one of the problems with using this 10-year T-note future as a proxy for 10 years, because it can vary depending on whatever the cheapest to deliver is. And the price of that is 105 and 19 seconds. And you might say, well, that doesn't make sense either because we're trading 112 and 13 seconds. It's because there's a conversion factor. And so that conversion factor happens to be 0.9402. And when you take that price and you divide it by 0.9402, the 105 to 19 seconds, you'll get actually something that's pretty close to 112 and 13 seconds. And so one of the things that you need to remember when you're trading T-note futures is that they are based upon whatever that cheapest to deliver is. And it can vary. It can mean that it's not always a 10-year. It could be an 8-year, 6-year. It could be an 11-year. It depends on whatever that list is that they're allowed to deliver into. And it'll move around based upon that cheapest to deliver. And that's basically it. I hope I helped you with that.
Yeah, perfect.
But the screen,
right.
Go have a look at that screen. That's really once you see that screen, that'll help you understand how the pricing works.
I guarantee you 90% of the members or listeners that are looking at that won't know what they're looking at.
Yeah, they will.
But anyway.
This is the second time you sold our audience short. They're going to figure it all out.
Okay,
And they're going to be doing basis trades in no time. Okay, here we go. Hello, Lena and gents. Love the work you all do and have been a regular listener for years. I went short on the Qs last day of the year with 119 and 2/1 dates. What does that mean?
The 19th of January and the 1st of February dates.
Oh, this is like
That's the dates.
Like they bought puts?
Like their dates on the options.
Oh, okay.
QQQ puts.
Well, the short Qs on the last day of the year was a great trade. The idea is that Santa Claus rally is overextended and a pullback is more than likely than new all-time highs right now. I would like to go further out in time because I don't think the Fed is going to cut in March unless something breaks between now and then. You obviously haven't talked to Patrick. My current strikes are 397 and 410 respectively. One is close to in the money and the other already is. I have profit targets for both, 4 times my original investment. How long would you hold these trades if I don't get to my profit target? And how do you determine good profit taking if your target is not met? Cheers, Matt.
Oh my God, they're asking for advice on the show, and we're not supposed to give advice.
You're not going to give. You're going to give regular generic advice.
Well, I'm going to just talk about the considerations. I mean, where options traders generally always run into the biggest trouble is when they go too short in duration, because what happens is you basically not only need to be about right about the price move, but you have to be right about the timing of which that price move is going to occur. Because if you only buy an option with 3 weeks or 4 or 5 weeks of time, you pretty much need that move working in your favor immediately. And the thing is that what our listeners did is doing a tactical swing trade. Is a basic, and for these types of time frames, you literally have to be a nimble trader, often using things like technical analysis so that you have some sort of immediate triggers to get in and out
Make sure
of.
your crayon isn't too thick as well.
But you see, Kev, for your little thick crayon there, would you be doing a 3-week option?
No, you're absolutely right.
Right? Like the whole point is that when you're going on this kind of a shorter time frame, you have to realize that this isn't a macro thesis. This isn't a bigger view of the market. This is what's the most immediate short-term move that will make you money in the next 2-3 weeks. And that has nothing to do with macro. That has nothing to do with the bigger economic cycles. That's that's flows, and what are the flows that are going to drive things in the next immediate short term. And really, I mean, the bigger thing that and all of our listeners need to kind of reflect upon is that you have to ask yourself what kind of investor you are and what you're actually looking for. Obviously, what attracts people to shorter dated options is they're generally cheaper, and therefore when you catch a move, you can truly compound that return bigger because you had a much smaller capital outlay. You can leverage it more. Right? But the benefit of buying more time is there's a lot of forgiveness about your timing being off, but your thesis being right. And that's always a fine line that I always try to evaluate, the cost benefit analysis of adding a couple extra months. And what I've noticed in the markets today is they often don't charge you that much more to go and add a few more months onto the trade. And keeping it short term like this just is going to give you too volatile of your outcome.
Okay. Is that it?
Do you have anything? But do you have?
I know I don't have
anything
anything to add. I'm not smart enough, and I'm just.
Go on, whatever.
I'm just happy.
Enough. You just don't want to add.
I'm happy you said my crayon might be little, but it's thick.
Oh my God, you went there, and Lena's not on the show to give her.
I know. It's the beer.
Laugh.
You give me the 10s, and I start saying things.
This is the part where you start slurring. I get it. So anyway, if anyone's got any questions to submit for Kevin and myself, you can submit them at nostupidquestions@themarkethuddle.com. As well, just one last plug there. Doing that great webinar on Monday on how to maximize your returns in the coming gold bull market. You can just register at bigpicturetrading.com. Just on the homepage, you'll see the link to sign up there. Kevin, let's close this show.
Thanks for tuning into the Market Huddle. We appreciate you spending some time with us. I'm not going to say where you can find us. You guys all know where you can find us. Patrick, where can they find you, though?
I just plugged it right now. This is good.
Yeah, you don't need to do it again.
Good. Let's just end this show. This has been a disaster.
Oh, come on, it hasn't been a disaster. It's
been a good show.
I think it's a lot more fun when Lena's on the show, but we managed to struggle through it. Listen, we can never have too many friends. Bear market, bull market. We're just happy to spend some time together on this crazy ride. Now stick around for the after show. We'll rate this beer and then we'll call it a day. Patrick.
So this is the one and done beer, buddy. This is like for lightweights like you. This is all you need.
I agree. I am a lightweight. Okay.
Well, I don't mean to think, but you don't normally drink. Right, and so
what's nice is that you actually.
My liver is so well trained.
Okay, so for an IPA, this is actually a pretty decent beer. I'm going to give it a decent rating because usually IPAs are undrinkable, and this is a lot better. And not only that, as I mentioned earlier, it's got a great name, a great logo. I'm giving it a 7.9.
I'm going to do better than that. I'm definitely going 8.4.
Yeah.
And exactly the thing. Great logo, great name. As Canadian boys. Here I am, a Canadian boy who I got out of Canada as fast as I possibly could after the holidays because my skin started to itch from all the cold. I'm not used to this.
Not only that, it wasn't even cold. It's by the way, it's like it's going to be cold, and Cuppy doesn't like the cold. I didn't realize this, but he's really soft. like really soft. So I've been sending him every single update saying, come on, time to come. I don't think I've convinced him.
I don't think
No,
so.
he literally
I don't think
says
so.
he's like, he's in.
Good luck getting me back there too.
You guys are both soft.
I'm becoming cuppy soft.
You are.
on this. You know what? Like I'm spoiled.
I know.
Like, you know what? Like even in Portugal, it doesn't get under 10 degrees in the winter, right? Like it's like being in the Carolinas in the U.S., right? Like or like some Texas or some weather, right? Like it's weather that's very reasonable for a winter. This idea that there will ever be snow is just doesn't happen. And, you know, but even then it was too cold for that. So that's why I'm sitting in Mexico right now.
Yeah,
I need this 29-degree weather.
Is it really?
Yeah.
Do you know what it's going to be like here? Let me just tell you.
I heard you guys have a snowstorm.
Yeah. Well, let me just see what we got going here. So it's 2 now. So we got to put that into. It's gonna be. I saw it was gonna be like minus 40 or 50 in the prairies.
Oh yeah, I know, because Larry, one of my members who's out in Calgary, said it was minus 37.
There we go. Now that's cold.
That's freaking cold.
No, that's cold.
But at least it's a dry cold. But that's cold.
It's a dry.
No, like, because if it was minus 37 in Ontario with the humidity, you would die. Like, at least the Calgary cold is like, when it's minus 30, you can actually still.
I'm just looking at this, minus 34 right now in Calgary.
You just have to like plug in your car. You know, like.
Oh, well, you know what? When I came from
80-90% of our listeners don't even know what that means.
No, I know. When I came to Toronto, I came from Winnipeg, and I literally had a plug on the front of the car. And the kids at school were like, what the hell? Why? Like, if you got an electric car? Like, this is back in the 80s. And I was like, no, like, that's where you plug it in. And they're like, are you shitting me? Like, and I was like, well, where do you guys plug it in? And they're like, plug it in. They had no clue what I was talking about. But for those who don't know, if you don't plug your car in, it basically doesn't turn over. It's so cold.
Because the oil literally like becomes a block.
Yeah.
You have to maintain a certain temperature in the engine so that that when you start it, the combustion can begin.
Yeah, so when you go to Winnipeg and you go to like an outdoor parking lot, you'll literally have spots to plug in your car. I wonder what they do now.
Oh my God.
Listen, and how does like those.
Canada's the best country.
I don't know why you left. Okay, on that note, let's call it a night. Okay, thanks for tuning in, everyone. Take care.